corporate subsidiaries are required to prepare their local financial results using IFRS recognition and measurement principles. This ensures the data is ready for the parent company to use in its consolidated group reports. This requirement creates a mismatch for unlisted legal entities. While they need the same measurement logic as the group, they are also forced to publish an extensive disclosure package designed specifically for public capital markets. Finance teams spend hundreds of hours drafting narratives for notes that may have no external users, and auditors spend equally long testing those notes against massive compliance checklists. IFRS 19 was issued by the International Accounting Standards Board to address this specific compliance load. The standard operates by decoupling measurement from disclosure. The full disclosure package is swapped for a streamlined framework, while the underlying accounting measurement remains intact. Every recognition and measurement rule, from IFRS 9 segmental instruments to IFRS 16 leases, remains fully applicable to the entity's numbers. This decoupling reduces the administrative task of note production. It avoids the need for a separate accounting framework, ensuring the subsidiary's data remains compatible with the parent's consolidation process. IFRS 19 is not available to every private company. It is a strictly gated reporting option. To qualify, an entity must satisfy 3 sequential tests. First, the entity must meet the definition of a subsidiary under IFRS 10, meaning it is controlled by another entity. Second, the subsidiary must have no public accountability at the end of its reporting period. This excludes any entity with debt or equity traded on a public market, along with banks, insurers, and mutual funds holding assets in a fiduciary capacity. Finally, the subsidiary's ultimate or intermediate parent must produce consolidated financial statements that are available for public use and compliant with IFRS. This creates a system of informational substitution. The regulator allows the subsidiary's notes to shrink because the parent's public consolidated statements already provide a broad layer of transparency to the market. For a financial preparer, applying this across dozens of existing IFRS standards requires a highly specific mechanical approach. Rather than providing a list of scattered exemptions, IFRS 19 acts as a centralized rule set. It replaces the disclosure sections of other standards in their entirety. Once elected, a preparer follows the specific requirements listed within IFRS 19 for every relevant accounting topic. This centralization reduces the risk of omission and provides a clear framework for both internal preparers and external auditors. There is also a technical distinction in how this election interacts with IAS 8, the standard for changes in accounting policies. Because the underlying measurement of assets and liabilities does not change, electing to apply or revoke IFRS 19 is not considered a change in accounting policy. Moving in and out of the regime is an administrative adjustment to the financial statement notes. It does not require the retrospective restatements or policy disclosures typically triggered by a shift in measurement. To understand the impact on the final report, we have to look at what information actually remains. We can see the compression strategy by looking at IFRS 16 leases. The standard removes the majority of the qualitative narratives and detailed descriptions regarding leasing activities. However, it retains the core income statement data. The depreciation charge for right-of-use assets and interest expense on lease liabilities must remain visible. Liquidity information is also protected. Total cash outflows for leases and a maturity analysis of lease liabilities are still required. This methodology reduces the text volume while maintaining the figures necessary to understand the entity's debt and leverage. A similar logic applies to high-risk estimation areas, such as IFRS 13 fair value. But Level 3 measurements, valuations derived from unobservable inputs, are specifically protected from this compression. Preparers must still disclose the valuation techniques used, the specific unobservable inputs, and quantitative gains or losses. The same retention logic applies to IAS 36 impairment, ensuring the assumptions used to test the value of goodwill remain transparent. The board's logic is consistent. Reduce administrative detail, but maintain full visibility over liquidity, solvency, and areas of high estimation uncertainty. There is a major risk that preparers view IFRS 19 as a simple instruction to delete notes. The standard includes a sufficiency mandate. If the reduced disclosure set is not enough for a user to understand a transaction, the entity must provide additional information. For example, an intricate business combination involving significant contingent consideration would likely cause this requirement to spike. In such cases, the entity cannot rely on the reduced baseline. Management must actively add supplemental disclosures to ensure the financial impact is clear. This shifts the focus of the audit. Rather than checking a list of mandatory requirements, the auditor and the firm must debate whether the level of disclosure is sufficient. By providing fewer hard rules, the standard increases the weight placed on professional judgment to prevent the loss of material information. At a macroscopic level, IFRS 19 allows a corporate group to operate with different layers of communication while sharing the same measurement foundation. For corporate finance departments, the benefit is a clear reduction in the time and cost of financial reporting. It eliminates the need to produce redundant disclosures at the subsidiary level that are already captured in the group accounts. However, the responsibility for transparency now rests more heavily on the preparer. If applied poorly, the reduction could create information gaps for local creditors or minority shareholders who do not have access to internal group data. Group-level reports are designed for the parent's investors. They do not always answer the specific credit or solvency questions relevant to a single legal entity. The success of IFRS 19 depends on this balance, leveraging the efficiency of reduced notes without losing the visibility required by the stakeholders of the subsidiary.